All right, so why don't we get started? So thank you guys for joining. I'm Mark LaMonica. I am going to be talking about global investing today, which hopefully will be interesting. Before we get started, anything you hear today is general advice. I don't know anything about you. I can't offer personal advice. If you're over in New Zealand, get a copy of our FAP from our website, morningstar.com.au, and the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you would like personal advice. All right, so yes, we are going to talk about global investing. One quick call out is that the full agenda for our conference was sent out today. So anyone who is interested in joining the conference, we would appreciate it. You can join in Sydney at the ICC, or you can join us online. All the sessions will be recorded. They'll be available for 30 days. We've got a special price of $27.50 for people who sign up now, which is an 80% discount from the full price tickets. And yeah, I think it's a great agenda. So Shani put together an agenda that really focuses on what we should be interested in as investors. So looking at goal setting, asset allocation, hearing from a lot of CIOs, so people who have a wide remit of the different places they can invest in, different asset classes, different countries, and really mirrors what a lot of us do as individual investors, because we can invest everywhere. And that's what today is about. We're going to look at investing overseas. So first off, let's talk about what has happened in markets in general over a longer time period. So we're going to go back and look at 10 years. And the reason we're going to illustrate this, here we go. So I'm looking at two different ETFs here. So I'm looking at VGS. So VGS they're both Vanguard ETFs. So VGS tracks something called the MSCI Global Index. So the MSCI Global Index really looks at developed markets around the world. So it's kind of the index that people use to track global investing. And then we've got Vanguard Australian Shares, which of course is tracking the ASX. So let's look at what's happened over the past 10 years. So a couple of things to note, and we'll talk about this today. VGS does include currency. So this is not a hedged ETF. If you don't know what hedging means, don't worry about it. We will spend some time talking about it today. So this does include currency movements as well. So what you can see is VGS, so a global investment, has outperformed Aussie investments. We'll talk about why in a second, but it is something that's important to note because, like all investors around the world, Australian investors exhibit a lot of home bias. And home bias simply refers to the fact that a lot of people are more comfortable investing in what they know. So that's what they do. So basically, companies companies that you potentially use every day, that you interact with, ones that are household names in Australia, a lot of people exhibit a lot of home bias. And that's something that can impact the returns you get. It can impact your ability to diversify your portfolio. So we'll talk about all that today. And a reason that I hear a lot from Australians why they exhibit home bias is franking credits. So of course, franking credits are valuable. Franking credits do add to returns. But if we look over the last 10 years between global markets and the Aussie markets, franking credits, as you can see, are not going to give you 41% over 10 years. So what franking credits do is approximately over the last 10 years gave you a little less than 2% a year in additional return. So that's not going to make up for it. And the other thing that we can add to this whole view, and we will talk about why this is important in a second, is we can, of course, add the US market as represented by IVV. So you can see US market 175% over the last 10 years, far exceeds what we've seen in other markets. Now, this, of course, does not mean it's going to continue, and we'll talk about some of the reasons why it may not. But once again, franking credits should not be the excuse. They would have served you poorly if that was the excuse for not investing overseas over the last 10 years. The other thing to note, and we'll talk about this in a second, is why this MSCI index did better than Australia is really because of one country, and that country is the US. So anytime we do want to talk about investing overseas, we have to talk about what that actually means and what global investing is. So you see the returns there. what I'm going to do, so once again, this is that Vanguard MSCI International ETF that I was talking about before, VGS. So what we can do is we can look at what is actually in it. So at a high level, of course, it's international equity, as you would expect. We go down a little bit, we can look at countries. So here you have it. The United States makes up around 70% of global developed market indexes. And we'll talk in a little bit about developing emerging market indexes, which are heavily made up of China. So it is something that's really important for people to remember. If you're trying to invest overseas, if you're using a product that tracks one of these indexes, understand what's in there, because all the literature you will hear and see is about how many different countries you're investing in. But look at this, at the end of the day, US, Japan, UK, Canada, Switzerland make up a huge percentage of this index. Really, just the top three of the US, Japan, and the UK make up 80% of that index. So just understand that that's what you're getting if you're investing in one of these. If you're investing in one of these indexes. What I also see a lot of people do is they quote unquote want to diversify and hear all this stuff about how well the US market's done. So what a lot of people do is they'll buy something like this, and then they'll double down by buying either that IVV, something that tracks the S&P 500, which is the 500 largest shares in the US, or potentially they like tech. So they'll move into one of those NASDAQ ETFs. So that is even more doubling up, tripling up your exposure to the US. So just remember that what matters when we're looking at diversification is not the number of ETFs you may hold, but what actually matters is what those ETFs are invested in. All right, so the other thing I wanted to take a look at is, and this will hopefully make sense in a second, is a big weighting to technology. Once again, largely driven by the US. So if we go and we look at the countries that are in this, or the companies that are in this, number one, you can see they're all American in terms of the top 10, but you're seeing a lot of technology companies. So once again, you are investing in a lot of technologies. When we talk about technology, we'll talk about why that may not be a good thing going forward, but why it's also important for Australian investors. All right, so quick overview. Now we're going to talk about why you would want to invest overseas as an Australian. So I tried to debunk some of the myths about, the advantages you get investing in Australia, but why do you want to invest overseas? Well, there's a couple different reasons you want to do that. And one of the largest reasons is that if you are just investing in Australia, you're investing in a very small part of global markets. So Australia makes up something like 2.5% of global market cap. So when we're looking at global market cap, what we're talking about is how much are all the companies in the world worth. So when we say market cap or market capitalization, it's the number of shares times the share price, which gives you how much the company's worth. So if we look at 2.5% of global markets, you're missing out on a lot. And specifically, if you just invest in Australia, you're missing out on a lot of different industries. So the Australian index, the Australian market, is dominated by mining and banking. And the other thing in Australia is Australia has a relatively low percentage, Australian companies have a relatively low percentage of revenue that comes from outside of Australia. Now, if you think about that, it kind of makes sense, right? If you start thinking about some of the giant companies in Australia, BHP, of course, almost all of their revenue comes from overseas. And that's true about a lot of the miners, right? Those are exports. But if you start looking at the other big companies in Australia, so whether that's the banks, which are largely domestically focused, companies like Telstra, Woolies, Coles, et cetera, a lot of these companies get most of their revenue in Australia. Now, whether that's a good or bad thing depends upon how the Australian economy does. But just remember that investing in Australia means that you're getting exposure to those two particular sectors, mining and banking, and that a lot of that's domestically focused. And one thing that's important to note with all of this, and people, every single time I do this, somebody asks me this question, so I'll just pre-answer it, is it does not really matter where a company is headquartered. Because what matters is, of course, what are the markets that they do business in? Because one of the reasons we want to invest, of course, internationally is we want to get exposure. We're in Australia, we want to get exposure to other sectors like technology that are underrepresented in Australia, but we also want to get exposure to different markets, and that is diversifying you, right? So that if something happens to the Australian economy, especially if you're somebody who lives and works here, you could have the double dip of economic pain, potentially having you lose your job, maybe reduce your wage growth or reduce your wages, while also having your investments impacted by the same recession. And you can, of course, have local recessions in Australia that do not impact the rest of the world, whereas you may not have that in some other larger economies that you would see sort of cascading effects, as we saw during the GFC, cascading effects of problems in the US globally. So, yep, couple reasons why you should invest overseas, particularly getting exposure to different industries that may not be available locally. So that is one reason. Let me go back and talk about some of the nuance about investing overseas. Okay, so there's really 3 different ways that you can do this. So of course you can go in and you can buy individual shares. So recently there has been a huge reduction in the cost, and it's become a lot more popular of individual investors going out there and buying overseas shares. So you do have a lot of brokers now that offer, quote unquote, free international trading, but even some of the prices have come down for major brokers as well. One thing I'd be very careful about with that free aspect of international trading is the fact that, of course, they charge you on the FX or the foreign exchange transactions. And a lot of them charge you a lot. So remember, there is still a cost. And that's probably a good time to turn our attention to currency trading, or to currency impacts as one of the big risks of investing overseas. So let me share my screen again. Anyone who's watched these knows this is always challenging for me. All right. Let's talk about some of the risks associated with investing overseas. So gave you all the good points, how you can diversify, why it makes sense to invest outside of Australia. But let's talk about one of the big risks. And one of the big risks is currency risk. So whether you are investing in individual shares, as I said, whether you're investing in managed funds, whether you're investing in ETFs, you will be faced with currency risk for the most part. And we'll talk about the exceptions. So let's go through an example of currency risk. So the first thing we have to do is obviously explain what happens. So anytime you are buying investments overseas, so whether that is an ETF that trades on the Australian market and then goes out and buys, let's say, US shares or bonds or anything else, or if you're directly investing in a company and you're paying those FX charges I was talking about, you are buying assets in different currencies, which of course means that we need to take your Australian dollars and we need to translate them into a different currency. And that's going to impact you in a couple different ways. So obviously that initial exchange rate is going to matter. It's going to matter what the exchange rate is if any income comes in, so any dividends or interest hits. So whether that's individual shares or ETFs, it's going to matter for that when it's translated back. And of course, it will matter when you sell those shares and what that exchange rate is when you take US dollars, in my example, and move back to Australian dollars. So very simply, and I know foreign exchange can confuse a lot of people. So it is a little tricky thing to think about, but very simply, if you invest overseas, you want the Australian dollar to get weaker against that currency over the life of that investment. I've got an example. So in this example, if you invest in an American company, you want the Australian dollar to fall. So anyone who travels overseas, think about it, it's the opposite, right? So what do I want if I go overseas? I want the Aussie dollar to be really strong. So when I'm buying stuff on that trip, it's really cheap. You want the opposite to happen. We want it to start strong, then we want it to fall. All right, so here's an example, Microsoft. All right, so let's say on August 30th, 2014, you bought Microsoft, $10,000. You got $10,000 Aussie, obviously not putting any FX fees in here. You went, you bought Microsoft. So Microsoft was trading for $45.43 in the US, in US dollars. You were able to buy 205 shares of Microsoft because at the time, one Australian dollar was worth more than, or was worth, sorry, $93 cents US. So you exchange your $10,000 for $9,313 US, about 205 shares. So fast forward to June 20th, 2020. One of the reasons I picked 2020 when I originally did this is that the Aussie dollar fell pretty significantly during those COVID months. So during that kind of market fall that occurred from February, March, and then kind of continuing, the Australian dollar dropped a lot. So all of a sudden, the Australian dollar went from 93 US cents to 68 US cents. That's supposed to be a S and not a D. All right, so Microsoft share price did fantastically. So it went up a lot. You still have 205 shares. You sold them for $38,000 US. You translated it back into the Aussie dollars. You got 56,500. So the return that you received in US dollars on Microsoft, literally the price appreciation that occurred in Microsoft was 313% during the 6-year period, which by the way is very good. So this would have been a very good trade of yours. But the Aussie dollar also fell significantly. And so your total return as an Australian, not counting any fees, but also not counting dividends, was 465%. So this is an example of the benefit of a falling Aussie dollar. Now, the Aussie dollar is still very weak. So Australian investors, particularly kind of this year, have been protected in a US market that's gone down. It's rallied recently, other than the last couple of days, but a US market that's gone down. Australian investors have been protected because the Australian dollar has actually fell. Now, not completely protected, but at least somewhat protected. So that is the impact of currency. Now, currency is a very, very difficult thing to figure out sort of what is happening with it. A couple things to think about is one of the big influences between how currencies move are the relative levels of interest rates in each country. So that's one thing that's important. Particularly in Australia, commodity prices generally have a lot of correlation with the Australian dollar. Now, that doesn't mean any of this will happen going forward, but when commodity prices are strong, when they're high, the Australian dollar actually tends to not do so great, which is kind of interesting because it's a little bit like counter-cyclical. In a way, meaning that commodity prices are generally driven or often driven by the economic cycle, which means the Australian dollar goes the opposite way. All right. Now, what can you do about this if you're worried about currency risk? And I do get this question all the time as well. Of course, you can hedge your investment. So to hedge an investment is to remove a risk. In this case, what we're hedging is currency risk. So we're removing currency risk. Now, there's all sorts of fancy ways that we can do this, but one nice thing about investing in 2022 is that in many cases, the product providers have done this for us. So a lot of international ETFs, in this case, Magellan, which is an active ETF, a lot of these international ETFs have removed currency risk. So they will offer a regular version, Magellan Global, and a hedged version. So anytime you see hedged, and I'll show you in our screener in a second, anytime you see hedged, you are going to remove currency risk. You will pay slightly higher fees for that because there's a cost associated with that hedging, but it will remove currency risk. You can see, and this is a little bit dated, but you can see the differences in the returns, right? So this hedge version was not around 10 years, but you can see, total return 11.77% versus 8.94. So of course, what matters here is, and what gets a better return, and both of these have the exact same securities in it. So they would have the exact same return except for currency impact. So removed here, kept there. So what that shows you, of course, is Australian dollar movements. Now, people often ask, which is better? Should I hedge? Should I not hedge? Well, from a pure investing standpoint, I can't tell you what's better because I don't know what's going to happen in the future. What I can tell you is that given the Australian dollar's weakness back since sort of, as I was saying, 2014, given the Australian dollar's weakness, it has been better to not be hedged. But I, of course, and neither does anyone else, have any idea what's going to happen in the future. And that's the only way I can tell you from an investing standpoint. But what I can tell you also is that you should think about your goals, and you should think about how this decision could impact your goals. Maybe it doesn't at all, or maybe it does a lot, right? So for instance, if you are retired, for example, or even if you just travel overseas a lot, you're also going to be exposed to the Aussie dollar, right? If the Australian dollar is weak, then of course it's going to cost you a lot more to go overseas. So that could be a case where you'd say, okay, I want an investment that balances that out, right? The Australian dollar is weak and costs you a lot to go to Europe. Well, your investment would go up if you were invested in Europe, right? With that weakness. So that is an opportunity to sort of hedge your own cash flows in that situation, if of course you spend a lot of time overseas. So this may not apply to everybody, but yeah, something to think about: hedge or not hedge. Over the long term, you would think that it wouldn't be too much of a problem if we're looking multi-decades, but of course you never know, right? And we've seen that. We've seen long periods of weakness in the Aussie dollar, and we've seen periods of strength in the Aussie dollar as well. All right, so we've got our first question. Okay, Lisa's saying, why did the global Magellan fund return exceed the hedged return? Yeah, simply because the Australian dollar got weaker. And that added to the returns of the unhedged version, right? So remember, the Australian dollar falls, that gets added onto your return. So you're making a return, just like in that Microsoft example, you're making a return from the underlying investment, and you're making a return from the currency movement as well. So yeah, something to think about. Okay, good question by Steven. So Steven says, could you also highlight the impact and risk of having investments domiciled in the US and your beneficiaries having to navigate the US tax and asset system at the end of your life as non-US citizens? Okay, really good question. Really good question. So there's a couple different options, as I talked about, in terms of investing overseas. So I talked about direct shares. So direct shares is one way to invest overseas. The other thing that people do is they often will buy US ETFs. And this has become kind of a phenomenon lately. So in the same trading accounts that if you use, well, pretty much every broker offers global trading, just at various price points, you can, of course, buy international shares, but then you also can buy international ETFs. So an ETF that's traded on the US exchange. Now, why would you do that? You do it because there are more ETFs in the US. Basically, there's a lot of selection, and there's a lot of selection around, well, I'm not going to make a judgment call, but there's a lot of selection around like individual company ETFs. So almost every, at least developed market, and a lot of emerging markets globally, you can go buy an ETF in the US that tracks that exchange. So a specific country. Can't really do that in Australia. They just haven't introduced all those products. A lot of the global ETFs involve multiple countries. So a lot of people have been starting to do this, but as Stephen said, of course, there's a couple different things that are happening there. So number one, you will owe US taxes. Of course, so if you own a US company or you own an ETF and there is a distribution or you sell that, you will owe US taxes on that. So that is one thing that you need to consider. And then Stephen's talking about beneficiaries as well. So yes, it's a little bit trickier, but in no way impossible. There just might be some more hoops to jump through. So, I have assets in the US because I'm a US citizen and an Australian citizen. And yeah, there's some stuff you need to navigate. But in terms of beneficiaries and everything else, that can all, of course, be worked out. It's just probably going to be a little more effort. And I think that's where you need to think about if that effort is worth it, considering you could just buy an ETF in Australia, where from a tax perspective, tax side of the US, would be taken care of for you. You would just have to pay your Aussie taxes on any distributions you get. So yeah, it's something to consider. It's certainly not, as I said, it's not impossible in any way. It just might take a little extra work. But they're really, once again, because of custody system in the US is a developed market, despite how we act sometimes. There is still the rule of law. You can certainly deal with all of that. You're not going to lose your money. But yeah, it might take a little effort. Okay, so we've got a question saying, so if the Aussie dollar is already weak, wouldn't it make more sense to buy hedged ETFs, considering the Aussie will possibly get stronger in the next few years? Yeah, I mean, so sort of the argument you're making here is that we're going to see reversion to the mean, right? So we go back to whatever, 2012, 13, something like that, that when there was parity between the Aussie dollar and the US dollar, we've obviously seen for a long period of time the Australian dollar get weaker. So yeah, I mean, I think that intuitively makes sense. Like, what is the floor on the Aussie dollar? Like, how low can it possibly go? I think intuitively that makes sense. But once again, like anything else investing, we have no idea what's going to happen. But sort of the argument there, which I generally agree with, is that just like if I go out and invest in the share market at a low valuation rate, there might be no driver that I see, no reason I see the market going up, but just investing at that low valuation rate, you got to figure, okay, well, at some point that will reverse. So yeah, I mean, I think that's a pretty decent strategy. What I would say is just be careful that this could last for years, right? So I think the Aussie dollar will get stronger against the US dollar at some point. Yeah, just don't know exactly when it's going to happen. So it all depends upon your time frame. Okay, so Pamela says, how is the fund actually hedged? What processes are different from an unhedged fund? So basically, there will be no difference in the actual, holdings that, of course, are in the portfolio. What they'll do is they'll put a hedge on top of that. And generally what they're going to do is they're going to use futures. So basically futures are a way you can hedge all sorts of stuff, but also currency. So basically what you're doing is you're buying currency futures to make sure that where the currency is locked in on, it's going to stay in terms of the portfolio, right? So you're just selling probably Aussie dollar forwards, or selling the Aussie dollar forwards. So what they do is, yeah, they just put that on top of the portfolio. All the holdings are the same. So there's derivatives. And so a derivative is something that derives its value from something else. So it's deriving its value off of currency. All right, yeah, so Eric has a good point. So another way to get exposure to overseas markets is to invest in Aussie shares whose operations are largely overseas. So Brambles and Amcor. Yeah, there are certainly companies in general. I'm saying if you buy the Australian index from a revenue standpoint and percentage overseas, it's a pretty domestically focused index. So particularly if you look at Europe. So if you look at some of the large European multinationals, so it's something like, and don't quote me on the exact number, like if you go to London and you look at the London exchange, something like 75% of the revenue comes from outside of the UK, of those companies that trade there. It's just less in Australia. But yeah, remember, it doesn't matter. As I said, it doesn't really matter where a company actually trades, right? Like, and BHP is the perfect example. So BHP derives 65% of its revenue just from China, right? So just selling iron ore and obviously various other things that BHP mines just from China. So, buying BHP is a China play. There's sort of no other way around it. And basically all commodities, because of the amount that China consumes, all commodities, all miners are a China play. So what happens in China will drive BHP's share price. And which is kind of the reality, right? There's nothing that happens in Australia from an economic standpoint, right? If the Australian economy went into an enormous recession or the Australian economy went into an enormous upswing, it's really not going to make any more money for BHP, all right? There'll be impacts because obviously they employ a lot of workers here and there'll be impacts certainly, but really what drives BHP is the Chinese economy. So it is a really good point by Eric that there are ways to get that exposure in different ways. So Peter is saying, does buying a US equities ETF like VTS listed on the ASX as opposed to buying directly a US stock or a listed US equity ETF have a different currency impact? It depends how you buy it. So if you go and look at what a lot of these brokers charge for FX, it's a lot. So if you go, especially some of these free brokers, but even ComSec, you know, they still charge a fair amount for FX. But if you go and look at some of these discount brokers like a Stake, something like that, that offer free international trades, they're not free. Go look at what they charge you for FX. So the difference is that if you were to go buy the same ETF that is in the US, it'd be a lot cheaper to buy it in Australia because you don't have to pay that huge transaction fee, in that case in FX, or the huge transaction fee from ComSec where they have a higher transaction fee and they charge you FX. You wouldn't have to pay that if you invest in Australia. So the only reason you'd want to buy an ETF, for example, we'll talk about individual shares, the only reason you'd want to buy an ETF overseas is if it's something you can't get in Australia and you think somehow that this is going to give you a return that makes up for the cost. Why you would buy a US listed stock is because you want exposure to a certain company. But once again, don't underestimate how much you're actually paying for that. Yeah, so Phil is saying, apart from convenience, why would you buy, say, IVV? So that's the S&P 500 ETF, my shares, as opposed to buying each of the major constituent shares directly? Yeah, I mean, I think convenience and cost. Like, you know, at the end of the day, right, IVV does represent 50 shares, or I mean, sorry, 500 shares in the S&P 500. So, you know, it'd be very difficult for you to replicate that and very expensive for you to replicate that. Like any other index, of course, it's driven by the top shares. So, yeah, I mean, I think just sort of inconvenience and cost of going out there and trying to replicate that index directly. Okay, so we got a good question. Do ETFs in Australia give frank distributions versus overseas ETFs? What is the difference between the distribution and dividends in terms of tax savings in Australia? Okay, so a couple different things we should talk about here. So if you are an income investor, so Australia, of course, has franking credits. Franking credits make dividend investing more attractive, right? It does add to your return that you're going to get as those credits are distributed to you. That has made dividend investing very popular in Australia. That has made companies in Australia pay higher dividends. So where in the US, there's generally, and this is a generalization, more of a bias towards buybacks. In Australia, you see more funds distributed through dividends than buybacks. So the Australian market almost always, including now, has a higher yield than many global markets, certainly more than the US. So the yield, of course, is the dividend that's getting paid divided by the price of the share. So higher yield means if yields 3%, I invest $1,000, I'm getting $30 back. Yields 2%, I'm getting $20 back a year. So generally, from an income investing perspective, in Australia, this is a big generalization, you get higher dividends. Then, of course, you get the franking credit. So yeah, both of those would come into play if you're buying an ETF. The only thing I would caution you about buying an ETF for income, and there's nothing wrong with doing it, but just realize that there are different components of that yield you're getting. It's a distribution yield. One of those components is capital gains being returned. So that can distort the yield on individual ETFs in particular years, depending upon how that happens. But yeah, no, you still get franking credits. And I know everybody loves franking credits, but just remember, franking credits are useful and they do add to your returns. But once again, if we go back and we look over the past 10 years. And really, if we go back and we look since kind of March of 2009, which is when the US market hit bottom in the GFC, if we look at the returns you got from the US, far exceed anything you would get from franking credits. Now, the US right now, from a valuation perspective, is very expensive. So we shouldn't anticipate those returns going forward. But all I'm saying is that, like, if somebody was sitting here in 2009 saying, I'm not buying US shares because of franking credits, it would not have been the right decision to make in terms of returns. Nobody knew what those were going to be. But franking credits have a value. Just don't overestimate what that value is. All right. Well, we don't have any other questions. Oh, here's a question. Now we have more questions. Yeah, so Scott's saying, if I buy a US ETF, will they produce tax statements showing dividend and capital distribution like Australian-based ETFs? The only caveat, the answer is yes. The only caveat I would make is if I buy a US ETF, I buy it out of a US brokerage account, you'd still be issued the same tax statement. So yes. Other thing to remember is just remember that, like, you know, the tax systems are fairly different. So like in the US, for the most part, depends upon your income, for the most part, you've got sort of a flat capital gains and dividend tax at 15%, rather than your marginal tax rate. Doesn't really matter, because at the end of the day, the Australian government will equalize that. So you'll just pay the taxes here. But yeah, you should still get that statement as well. Okay, so Peter's saying, I already have US currency and I want this currency exposure. Does an ASX listed US ETF like VTS have the same currency impact as buying a US listed and denominated ETF? Yeah, it does. So basically it's just more expensive for you to do it, trading the FX. So if we think about what actually happens with an ETF, so let me actually explain this. So if you buy a ETF that's invested in US shares and you're an Australian, you will buy that ETF with Australian dollars. Those Australian dollars will then get translated into or changed into US dollars by the ETF company to go buy the individual shares that go in there. So that will all be done at the company level, right? So all the money that goes in will just get translated over. Vice versa when you're selling it, and they need to wind those things down. And it's a little bit of an archaic way that it happens with authorized participants and everything else, which is how an ETF functions. But think about it that way. So you are not paying directly for that, or what you are paying for is there, of course, will be FX charges that will be a cost associated with it, but the ETF companies doing it. Giant investment banks around the world that are participating in this are doing it. They can get a better deal than Stake will give you if you invest individually in a US ETF. So then you will take your money, Stake will take your $1,000, they will convert it into US dollars, and they'll charge you a heavy fee to do that, because that's how they make money. So just they will get better rates than you will get. So just remember that. But yeah, you still have the exposure, right? Those assets that are in the ETF are still US assets denominated in US dollars. So remember, a ETF or a fund or anything else is just this kind of vehicle to buy what's ever in there. And what's in there, if you're buying a US ETF or an ETF like IVV that invests in the US, what's in there, what's in that basket are US denominated assets that trade various exchanges in the US. All right. Very good question by John. So John said, is there better liquidity in US ETFs versus Aussie ETFs? Okay, really good question. So let's talk about what liquidity means. So liquidity, liquidity just refers to basically how many transactions there are in ETFs. You know, how many buyers and sellers are out there all the time. Could be an ETF, it could be an individual share. What we want as investors is we generally want really high liquidity, right? So liquidity will, number one, narrow that bid-ask spread or the buy-sell spread. So that is the difference between what a buyer pays for something and what a seller sells something for. So generally those spreads are pretty narrow, but the more liquidity, the narrower they will get. That's another form of transaction costs. So it's not a direct brokerage cost, but that bid-ask spread, you can see it, right? You can see it on, if you go into a trading platform, you can see what that bid-ask spread is. So you do want things that are more liquid. So it depends on the ETF, but generally, yes. So the US is a bigger market. A lot more shares change hands in the US. And so there's more liquidity. So that could have an impact. The other impact you could have is what you want to look for when you're investing in ETF is low tracking error. So tracking error refers to the ability of that ETF, that index provider, to track that index. Now, so that doesn't necessarily matter what exchange you traded on, but it matters what market you trade in, right? So you could potentially have bigger tracking error if you are investing in less liquid markets, where there's bigger problems basically for the ETF company to transact when they're trying to build up their positions and track an index. So yeah, that could be an impact as well. But once again, if you're investing in major markets, you should have pretty low tracking error. The last thing that I'll say, I guess, about ETFs, sort of related to a lot of the questions that we get, if you're investing in global ETFs, there are times to do it and there are times not to do it. And when I say times, I mean literally during the trading day. Try to trade during the middle of the day. So what you'll often see is you will see a difference. So an ETF is trying to trade for the same price as the net asset value. I'm sorry, I know we're getting complicated here. Trying to trade for the same price as the net asset value of everything that's held in the ETF, right? Because remember, an ETF's trading on an exchange. So what's going to drive the price of that ETF are buyers and sellers and how many there are of each. So that means ETFs can deviate between the price and the NAV. So that does happen. And there are mechanisms in place that I was referring to earlier around sort of creation units and how ETFs are created. There are mechanisms in place to make sure that gap's as little as possible. But those mechanisms, sometimes at market open and market close in Australia, that gap can widen. So our analysts recommend buy those international ETFs, and honestly, any ETFs, buy them, wait a couple hours or wait an hour after the market opens. It's probably isn't even that long, but buying them at the open, sometimes you have distortions in those prices. So there can be a bigger gap. So we've got a question about an ADR. So an ADR is an American depository receipt. And basically what this is, and this happens, all sorts of stuff. Basically what this is when a foreign company trades on a US exchange. So why do they do this? They do this, of course, because they want to list on a US exchange because they think, because it's a larger market, they think, of course, it's a good way to make it easy to get more shareholders and keep the share price up. So basically the way that an ADR works, like not getting too technical about it, is that a bank will set up, a foreign company will say they want to do this. A bank will basically set up a depository receipt that represents shares in a different country. So for all practical purposes, what it means is, you could buy a UK company in American dollars on a US exchange. And this is different than cross-listing, right? A lot of companies will cross-list as well. This is different. So I own some ADR, so it makes no practical difference really, except for it will be priced in US dollars. you'll get the distribution, you'll get the dividends, you'll get everything else. So yeah, not really any sort of difference. Like technically you're buying a depository receipt that represents shares that are then trading in another country. So yeah, that's an ADR. All right, I think we answered all the questions. Well, anyway, thank you guys. So on Thursday, we'll be talking about Fortescue, which is always exciting. Speaking of companies like companies that sell a lot of stuff to China. So on Thursday, we'll be talking about Fortescue. If you have any questions or would like a conference ticket, feel free to email me at mark.lamonica1@morningstar.com. And I hope everyone has a good day.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.